In the world of economics, fortunes can change and losers of yesterday can turn winner of tomorrow. Now that's what's playing out in the Europe's bond markets. Now as sovereign bonds spreads narrow, traditional fiscal heavyweights like France and Germany are losing out to nations that have struggled in recent times. Now let's take a closer look at who's winning investor confidence and who's losing. Well, first up, let's take Germany. Germany is the largest economic bloc in the Eurozone and is known for its stability. But as the nation undergoes an economic transformation, investors are noticing a hit to its sovereign bond market. 10-year German bond yields have risen notably after Chancellor Friedrich Merz proposed a €1 trillion spending drive on infrastructure and defense. This pivot has cast a shadow of uncertainty on Germany's economy and its debt levels. Now let's move across to WION in France. It is considered another pillar of Eurozone stability, but French bond spreads have widened relatively to some of its neighbors. For example, Spain now borrows at a lower cost than France over a 10-year period. Investors are increasingly growing weary of France's growing fiscal imbalances, especially as other economies in the Eurozone emerge as more stable bets. And among those emerging bets is Spain. Spain's economic rebound has been one of the success stories of the past year. Stronger than expected GDP narrowed the bond spreads between German and Spanish bonds over a 10-year period. Economists are also more optimistic about the country's medium-term growth outlook. Next up, Italy has been considered a fiscal risk as debt exceeded 130% of GDP during the heights of the Eurozone debt turmoil. But the country is increasingly emerging as a safe bet in the Eurozone. Prime Minister Giorgia Meloni's government has walked a cautious economic course, reassuring investors that Italy is a safe bet. Now, investors and economists are closely watching Greece's debt levels as it was the epicenter of the Eurozone debt crisis. But since then, the Greek economy has regained its investment grade status and continues to walk a disciplined fiscal path. In fact, investors say a decade after its dramatic bailout, Greece is a case study in debt rehabilitation. While risks remain due to high debt to GDP ratios, the losers of their previous debt crisis in Europe may have managed to turn winners of the current bond spreads, proving yet again that in economics, yesterday's losers can turn winners.